Today we're breaking down one of the most popular and beginner-friendly strategies in options trading, the options wheel strategy. If you're looking for a smart way to generate consistent income from stocks you already want to own, this one's for you. What is the options wheel? The options wheel is a strategy that uses cash-secured puts and covered calls in a repeating cycle to collect premium and potentially buy and sell shares of stock for profit. It's called a wheel because it keeps spinning. You earn income whether the stock goes up, down, or sideways. Step 1. Sell a cash-secured put. Step 1 is to sell a cash-secured put on a stock you're comfortable owning. Let's say you want to own shares of stock ABC, currently trading at $50. You sell a put with a $48 strike price and get paid, let's say, $1.50 per share. That's $150 per contract. And here's the key, you keep that $150 no matter what happens. But you must be ready to buy 100 shares of ABC at $48 if the stock drops below that strike at expiration. That's why it's called cash secured. You've set aside the $4,800 in case you get assigned. Step 2. Get assigned and buy the stock if the stock stays above $48. Great. Your put expires worthless, and you keep the premium. You can do it again the next week or month. But if the stock falls below $48, you're assigned the shares, so now you own 100 shares of ABC at $48 each. That's still a stock you wanted to own, remember? Step 3. Sell a covered call. Now that you own the shares, it's time for step 3, sell a covered call. You sell a call option with a strike price of, say, $50. If ABC climbs back to $50, your shares may get called away. You sell them at $50 and profit $2 per share plus the call premium you collected. If ABC stays below $50, you keep the shares and the premium. Either way, you win. You can sell another call next week or next month. The wheel spins again. If your shares get called away, you're back to step 1, selling a cash-secured put. That's the wheel in motion. Every cycle, you're collecting premium, sometimes buying low, sometimes selling high, and ideally both. Real numbers example. Let's walk through a quick example. Sell one cash-secured put at a $48 strike, collect $150, get assigned by 100 shares at $48, sell a covered call at $50, collect another $150. Stock hits $50, your shares are called away. You earn $2 per share on stock gain plus $150 from each option equals $500 total profit on a $4,800 investment in just a few weeks. Risks and considerations. This strategy isn't risk-free. Your biggest risk is that the stock drops significantly after you sell the put, and you're stuck holding it at a higher price. That's why you should only use the wheel on stocks you'd genuinely be happy to own long-term, ideally with strong fundamentals or dividend payouts. Also, don't forget, you need enough cash to buy 100 shares of the stock per put contract. Why people love the wheel. The options wheel is popular because it creates consistent cash flow, works best in sideways or slow growth markets, and is easy to understand. You're not chasing risky moves, just collecting steady income and managing stocks you believe in. Wrap up. So that's the wheel strategy. A powerful, repeatable way to generate income and build a position in stocks you love. If you found this helpful, hit that like button, subscribe for more trading strategies, and drop a comment below if you've tried the wheel.